Tony Greco, Senior Tax Advisor, Institute of Public Accountants. What I'm about to talk to you today about is just the looming end of financial year. We've got some tax tips. As with most end of financial years, there's certain things that need to be done before the end of the financial year, and there's also opportunities which will no longer present themselves in the new financial year. So there's a bit of both. Firstly, typical this time of year is companies go out and buy things before the end of the financial year. Slightly different set of circumstances for this financial year, in that on the 1st of July, the small asset write-off for assets increases from 1,000 to 6,500. So what we're saying to people is, if the item costs less than $1,000, by all means, go out and spend before the 30th of June, claim your instant write-off in this financial year. If, however, it costs between 1,000 and 6,500, what we're saying to people is you're better off holding off and buying that in the new financial year, i.e. after the 1st of July. So that's something to keep hold of. The other incentive to delay relates to motor vehicles. The depreciation environment in the new financial year is much more attractive. There's an instant $5,000 write-off, as well as normal depreciation. So if you are thinking of updating a vehicle, it's probably best to wait to the new financial year to avail yourselves of those incentives. The other item that is going to impact on a lot of people is superannuation. The budget made some announcements. One in particular affects those over 50. There's a window of opportunity to increase your contributions this year, because you may not have the opportunity in the next 2 years to top up, especially if you're over 50. Those who are currently or will be 50 by the end of the year, so all you need to do is be 50 by the 30th of June, but before that date, you have got the option of claiming up to $50,000 in what we call concessional super contributions, i.e. those that you can claim a tax deduction for, or salary sacrifice. Now, that will be taken away from people come the 1st of July, so they'll no longer have access to that additional $25,000. So it becomes fairly simple for the next 2 years. Regardless of age, everyone will have the one cap, which is going to be $25,000. Also, another thing that high income earners should be wary of is the fact that the superannuation super surcharge looks like coming back into operation for high income earners. We're talking people with incomes in excess of $300,000. They will be subject to a higher level of contribution tax in the super fund. So there's another advantage for high income earners to step on the pedal this year rather than next year when it relates to superannuation contributions. It's still quite attractive to put in place what we call after-tax super contributions. So if you are, or you have the capacity, it's also good to look at what we call after-tax super contributions, the non-deductible. The other thing to look into is the normal year-end housekeeping, what we call housekeeping items, which is debtors. Make sure that you have written off bad debts this year, bring forward the deduction. Same with stock. Stock is one of those areas that you have a lot of choices as far as valuation, and that could have a significant impact on your profit. You can value at cost, market value, or realisable value, and that can have big implications for the bottom line. Also, same as debtors, if you do have stocks which are just sitting on the shelf, not going anywhere, you might want to scrap those items or physically remove them and bring down the value of stock, which gives you an instant deduction. The other things you should look at is also prepayment of expenses. Normally you don't have to physically pay to get the tax deduction. Most expenses, you can, as long as you've incurred those services or goods or received those goods, then you are entitled to a deduction. The one exception is superannuation. If you want to claim the deduction in this financial year, you must have paid the superannuation. So there is one exception. Now we will be running roadshows on Tax Time 2012. That's an opportunity for practitioners to get a fairly detailed hands-on analysis of what they need to look out for the 2012 tax year. So encourage people to look at the telephone number or website address at the bottom of this presentation to avail yourself of those opportunities.